Now, I want to get your views, first of all, on the equity market. I mean, I don't think anyone saw this slide coming to this extent. What's your view?
Well, thank you. Well, like you said, I mean, I didn't see it, but I think a combination of things. There's just so much being pushed through the system. I mean, there's AMCOM, there's bank regulations, there's universal banking guideline, and and then there's election and the political risk over and on the market. So I think people are just being cautious and taking profit where they and there are people are holding large profit in the likes of Nestle, Guinness. So I think they're taking profit and waiting on the sidelines for more clarity, and of course waiting for AMCON to bring in the desired liquidity into the markets.
I mean, you mentioned guidelines, which is one of the things I wanted us to discuss today. The investment rules for pension funds there's an exposure draft proposing some reviews to those. Can you just give us a sense of the major changes we are anticipating?
Well, I mean, what has happened is that the regulator, PENCOM, is trying to expand the investment universe to include other more, I think we would say, asset classes that could give more returns, obviously with some level of higher risk. So the major changes we've seen today in the exposure draft is the private equities are being proposed to be introduced, allowed pension funds to invest in private equities, infrastructure, either through funds or bonds or even directly in infrastructure projects. We're also looking at direct issuance of commercial papers, so PFAs can actually invest in commercial papers directly without going through banks. And more importantly, I think for me, the introduction of some inflation index bonds that will allow PFAs, to buy bonds that will hedge against inflation risk.
Right. Obviously, the key issue of real return has been on the spotlight,
yes,
where bond yields are in the market right now. But give us a sense of what impact do you think these changes will have on the market? Obviously, pension funds put together about 2 trillion assets under management.
Yes.
It's good. Obviously, they can have a huge impact and bearing on the financial markets. But what impact do you think these changes that have been proposed would have, particularly to the equity and, say, the fixed income market?
Well, I think I'll start from the fixed income market. Before now, the market has been dominated by FGN and sovereign issues. I think pension funds will begin to look for other issues. So I think that demand for federal government securities, at least by pension funds, will reduce, especially if those bonds are not inflation indexed, because the yields on the 20-year FGM bond is just slightly below 12%.
So we could see a correction.
Oh yes, inflation is below, is around 13.7. So we could see a correction in the sense that, we could see yields going up because the demand will reduce. On the equity side, I think there are a lot more asset classes today. So we have a choice. Before now, to get real return in Nigeria, you had to buy equities listed in the market. So I think that, unfortunately, going into next year, I think we are going to see a reduction in liquidity from the pension funds into the equity markets, because presumably they will begin to look at private equity and particularly infrastructure. I think the strongest case, Wole, is the area of infrastructure where pension funds can potentially put in 20% of the funds into infrastructure, and we have a huge infrastructure deficit in the country. So I think that for issuers, if well structured, infrastructure projects could really attract a lot of attention from pension funds. Well, overall, I think it's a very good, guideline. Obviously, it's still an exposure draft, so it's being debated by, interesting. Everybody in the financial market is interested in it, because pension funds is $11 billion today and growing, rapidly. So I think that it will have a profound impact on financial markets.
And lastly, you mentioned the issue of inflation index bonds. How practical do you think it is to get that going in the market right now?
Well, the inflation index bond has been around forever. The first issuance was done somewhere in either the States or in the UK in 1792, and it's today globally a $1.5 trillion market. So, inflation, the way it works is that basically you index the principal, to inflation. So inflation goes up, you adjust the principal so that the coupon rate remains the same, but the coupons that the investors get then changes to, compensate for inflation. So I think it's practical. I expect the FGN to come in and issue the first inflation index bonds. The regulation today says anything above 7 years. If you ask me, this is entirely personal. I think that 7 years is a bit too long, because you might see issuers migrating to the short-term end of the market and then try to crowd out that market, because when everybody is now issuing 5-year bonds, then yields will collapse on that side, whereas there will be scarcity of papers on the long-term side of the market. So I think that is practically, it has challenges. It has never been done here, but I suspect that as usual, once the federal government takes the lead, other issuers will follow, and we'll begin to see a market that I think potentially can become one of the biggest asset classes, locally, because obviously of the attendant benefits.